Okay, hello friends. This is a summary of a YouTube video I watched on the BagHolder Pod channel. Alright, the link is here. Alright, I'll link it in the description below. Alright, basically, it's these 4 people who are financial YouTubers who managed to interview Adam Khoo, whom I'm somewhat of a fan of. Right, so some background. Adam Khoo, he's a businessman, right? Investment and trading trainer, right? Also education trainer, right? And why I trying to do a video is because I like his clarity of mind when he discuss some things in this video, right? He's very clear about why he does some things, why he invests in some businesses because of their moat, their fundamentals, alright, and certainty, and why he does not invest in other things like Tesla, right? And I think that for me, he understands Buffett and Lynch at a deeper level than most people on the internet, right? So, and I realized that one of the reasons I think he does understand Buffett and Lynch so much better than the normal people on internet is because he is actually someone who teaches investment, right? And he writes books about them. I've actually read a few of his books, and his core ideas, I believe, come from Buffett, right? So I think teaching and writing is one of the best ways to learn something well, because you actually internalize the content much better because you're forced to. Right. So anyway, Bunty asked him about DCA versus timing the market because 2022 has been a bad year for people DCAing, right? You will keep losing money as you average down. So Adam Khoo shared his experience that he was first a trader more than an investor, right? He made a lot of money long and short in 2008 and 2009 using moving averages, right? But this method of trading failed in 2011, 2016 and 2018, right? Because the plunge and spike due to these crashes were too fast, right? And I believe that the reason why his trading methods it didn't work is because the moving averages actually take some time to indicate that there is a downtrend, right? So by the time they indicate a downtrend and you short, right, if the thing go up too fast, right, you actually get stopped out of your trade. That's why you lose money, right? And he also discussed the fact that buy and hold also works sometimes, alright? It's basically the opposite of the above. If you buy and hold in 2008, 2009, right, you basically lose money all the way down because like this period, the market just keeps going down, right? But you will make money from 2011 onwards, right? Because from 2011 until probably sometime recently, 2020 or 2021, right, it's more or less a straight line bull market, right? So all these periods you will make money, right? So his philosophy is you should do what works for you consistently. Don't jump from one ship to another, right? All strategies work well sometimes and not so well at other times, right? And jumping is what gets you into trouble. He did back testing, and he says that over 30 years, right, if you are consistent with market timing, which is trading or buy and hold, right, he feels like the results, his back testing show that the results is actually roughly the same, right? So for him, he has decided not to time his core portfolio, which means the fundamentally sound companies that he believes in. He just buys when he feels that is a good value to buy, right? Because when you do market timing, if you mess it up, right, it can affect your returns badly, right? He also discussed the fact that sometimes macro-wise, the whole market speed is high, right? Will you sell, which is timing the market again, right? So for him, he says that sometimes you realize that the high market speed is very high, but it just keeps carrying on going higher. So in this way, is again not possible to predict the macro environment. What can actually be done in the macro environment? And Peter Lynch has this very famous saying that even the Fed chair, who is the boss of the Federal Reserve, cannot predict long-term interest rates, right? Much less people like us who are not even in that seat to look at the data that he has available to him, right? So if even the Fed chair cannot predict interest rates and he's supposed to be the best person to control it, right? How can we, right? And this person, John Maynard Keynes, which is I think the father of macroeconomics, right? When he invested based on his macroeconomics knowledge, he went bankrupt 3 times. He only achieved success by ignoring the macro and buying good business undervalued like Buffett, right? So and this part is the part that I found most interesting. He says he does economic predictions on YouTube for entertainment only. It doesn't actually affect his investment processes. So a lot of times when I watch his YouTube channel for finance, I think that I guess you probably shouldn't base your decisions based on his macroeconomic forecast lah, right? Since he says he's for entertainment only, right? So so he talks about the fact that the mindset in investment matters, right? So because a lot of the people in that podcast were saying, wow, 2022 was a very bad year for everyone. Should we have tried to get out and then get in at a later time? And for Adam Khoo, he says that it's a bad year only because you are thinking about the money you lost. If you think about the fact that you can buy more because you are young and you're building wealth over the next 10 years, this is actually a very good thing to happen in the market. Because if the market went higher and higher, then you can buy less and less of the stocks that you feel are good, right? So if you're looking in the long term, 10 to 15 years, then actually it's a good thing that the market is falling, right? So the perspective and the language that you use determines how you feel, right? Don't worry about things like the macro. Just worry about the fundamentals of the company, whether they can survive a recession or not, whether you bought at a good price, whether they have economic moat, right? And talks about the moat a lot later, right? He keeps stressing that investing is not really about very high IQ. It's not about emotional control, and his actual edge in investment is emotional management, or looking at things from the correct perspective, right? He doesn't have any special technical indicator or special DCA method that helps him outperform the market, right? He just tries to control his emotions, right? And he was pressed to talk about Tesla, right? So he said that I'll never invest in Tesla, I'll only trade, right? He admits that it's possible that Tesla will make more money than a boring company like Hershey's Chocolates, but he's more comfortable with Hershey's Chocolates, right? He feels that Tesla, one of the disadvantages is high maintenance capex, right? Because car company, right? And he's uncomfortable with Elon Musk, which he feels like Tesla is very dependent on, right? And for Musk, let's say he steps down or steps away, or at this point he's distracted with Twitter and he seems to be damaging the brand value of Tesla, right? All these things are not good for the company, right? And Adam Khoo doesn't like that. He stresses that he wants certainty over 5 to 10 years, right? And from his research, he discussed nature of airplane and car companies are all the same, right? No matter how well you do at first, in the end it's a bad outcome. Almost all of them die out or have overall negative earnings. That's why he doesn't like the space of car companies, right? So he was asked about falling knives. Do we catch a falling knife? And here again, I think he's very clear-headed in answering the question. He says you must be clear whether you're investing or trading. It cannot be you trade then you lose money, you decide that it's going to be an investment, right? If you trade, you cut loss. Because this is not a company you like the fundamentals of, or maybe you don't understand the fundamentals. But if you understand the fundamentals, then it's investing. Then the sound solution is buy more because you believe in the future of the company, you believe the company is good, right? And in general, he discussed the fact that all traders eventually fail. Jesse Livermore, widely regarded as the best trader ever, right, made inflation-adjusted billions, but he went bankrupt 3 times, committed suicide, right? Turtle Trader, the one who trained people to train with his trading style with large success, right? In the end, he also lost money, all right? Right, so he talks about moat, which is the most important thing to him in investment, right? He talks about some companies that have brand moats like Nike, Apple, and Coke. All of them are asset-light business. Their production is all outsourced, right? Coke just has the formula, Nike just has the brand and marketing. Apple I think is also brand and ecosystem, right? Ecosystem lock, so high switching costs, right? So Apple has an ecosystem whereby it's hard to get out of, right? AWS also locks things like Netflix and Disney inside, right? Netflix has famously said that it takes 3 years for them to transfer out of AWS, right, which is Amazon Web Services, right? And this is basically forcing Netflix to pay AWS whatever they want, right? Because Netflix can't go down for 3 years, right? So network effect, things like Facebook, Amazon, right? Scale, Costco, Tesla, right? Tesla because they can, as they produce more and more, the costs get lower and lower, so their margins get better, right? Barriers to entry, right? He actually prefers Ferrari over Tesla because he has less competition, right? Ferrari works in the ultra high wealth category. Tesla is in the premium market, right? So Tesla can be sort of people who buy Tesla possibly may buy Toyota, but people who buy Ferrari doesn't look at Toyota as an alternative, right? So he actually thinks Ferrari has more mode than Tesla, right? And he talks about the fact that innovation and technology is not a mode, right? The fact that Apple came out with a very good iPhone, he didn't feel like at that point it was a good company. It's only when Apple's brand became established and its ecosystems start to come out that he felt like Apple is good, because he feels like you need at least 2 things out of these 5 for you to consider it a good company, right? So Apple will have brand mode as well as ecosystem mode, right? Right. So he was also pressed to discuss what should people buy over the long term, right? So again, I'll stress this is not a recommendation to buy and sell, right? I'm not a financial advisor, and I'm pretty sure Adam Khoo also said this is not financial advice. All right. So please do your research before you do anything. Okay, and consult your financial advisor if you need to, right? He likes healthcare the most because if in terms of sectors, he says there are 5 sectors. Buy the best 2 companies in each sector. That's how to find 10 stocks for a 10-year portfolio, right? He just dropped his favorites, right? He likes healthcare out of the 5 sectors the most because it's growth and it's defensive, right? I believe the company he stated was Thermo Fisher, right? Sorry for the spelling, all right? And United Health. Right, for financials, he likes S&P Global and Intercontinental Exchange, which I believe owns the New York Stock Exchange, Visa and MasterCard. I learned something again from this video, right? He said that Visa and MasterCard are actually not credit cards companies. They don't have debt risk, right? Only Amex takes on the debt risk from the consumer. Visa and MasterCard are payment gateways, which means to say the bank that uses them as a payment gateway takes on the debt risk. So Visa and MasterCard actually has no debt risk. Right, they are just like a toll booth, right? You use their system, you pay a fee, and they still have growth, right? That's why he likes Visa and MasterCard, right? Consumer discretionary, Amazon, Nike, Booking.com. I believe he said Booking.com, right? Staples are Costco, Coke, Estee Lauder, right? This is his favorite because he feels like most consumer staples have no growth, but Estee Lauder seems to have growth built in, right? Tech, Microsoft, right? Again, we stress that this is not financial advice. Please do your due diligence before you buy anything. Alright, there's no buy and sell call in this presentation. Alright, with that, thank you for listening. Goodbye.